You're welcome back. Let's continue our conversation on Nigeria's monetary policies. Now, this time we will be joined by a senior macroeconomist from the Ecobank London, Gaimin Nonyan. Good afternoon, Gaimin.
Good afternoon.
If you can hear me, the IMF chief, Ms. Christine Lagarde, she is still in Nigeria, and she says that we do not need any form of intervention in form of loans, despite the challenges that the country faces. What is your take on this?
Well, Nigeria still has a healthy level of foreign exchange reserves. It's about 29 billion US dollars. So that can still go some way towards helping to prop up all the imbalances in the country at the moment. Although, having said that, it's down. The foreign exchange reserves are down 70% from a year ago, which means they have to be looking for Plan B, considering that the oil price outlook is weak, and at the same time, Nigeria's got very low levels of debt. External debt is about 2%, public debt it's about 10%. So it still has a lot of room to maneuver in terms of borrowing from foreign sources. So it's not in acute need to get some funding from the multilateral agencies, although that can help, but unlike other smaller economies which are in dire need of foreign exchange loans, I would say Nigeria still has a healthy level of reserves and to help to support its economy.
Now, there are concerns. You talked about the fixed markets now. There are concerns that the U.S. may begin to raise interest rates this year. And many say this may impact on Nigeria's borrowing costs abroad. Do you think so?
Yeah, absolutely. I mean, in fact, the U.S. started to raise interest rates last December, and the concern now is on how aggressive it's going to continue to raise interest rates because it has a target to meet. It's increased rates by about 25 basis points last December, and the concern is whether it will continue to increase at about 25 basis points in the next 4 quarters, in March, June, September, and December this year, or whether it will increase by even higher levels of 50 basis points, because as it does so, then we're likely to see some continued strengthening of the US dollar, and at the same time, investors are likely to move their money outside from frontier markets, which are perceived to be more risky, to less risky markets such as the US economy. And what that means for Nigeria is that this will lead to capital outflows, which will continue to put further downward pressure on the naira, and we'll see continued weakening of the naira as a result.
Okay, I just asked my last guest about how our financial authorities can balance the flexibility that the IMF chief was talking about, having to know that while we may want to help the poor, we have to be very careful how we will draw from the reserves to help support the state of the naira. But let's just move on to the issue of the commodities prices. Of course, they are at their lowest level, and this has had a major impact on commodity exporting countries, including Nigeria. What would be a good idea would it be a good idea rather for Nigeria to further devalue the naira based on this development?
Well, absolutely. Nigeria is a significant import-dependent economy. Most of what it consumes are imported, so it needs foreign exchange to import these goods and services from abroad. And this is what's happening. Significant import demand in an environment of low foreign exchange reserves is having putting downward pressure on the currency. And we've already seen that in the black markets or the parallel exchange rate markets, the currency has been devalued to about 270. It's now trading about 270 to the dollar, whereas in the official markets, the interbank exchange rate markets, it's still below 200. naira about 199. So this simply shows the structural imbalance between USD demand and supply for the naira, and so this will continue to put downward pressure, especially now that the government is thinking of increasing spending by about 25% this year, which means that there are going to be more goods that are being imported and services as well, which will be imported. That means that they'll need more foreign exchange. And as demand for foreign exchange increases, the value of the local currency reduces. So I think it's a matter of time when they will devalue and not whether they will devalue.
All right, that'll be all. Ms. Gaimin Nonyan, thank you for your time with us on the program. Gaimin Nonyan is a senior macroeconomist with EcoBank in London, and that is it here on Business Incorporated. Thank you so much for spending your time with us on the show. We hope to see you same time tomorrow. I am Bolaji Akinwale. Bye-bye.